Welcome back to Intermediate Accounting and to our very last video of the semester. This video concludes Chapter 21, Accounting for Leases. Let's do a quick overview of finance and operating lease accounting. Remember, regardless of whether a lease is classified as operating or finance, it is recorded as an asset and a liability on the balance sheet. Under a finance lease, the lessee records interest expense each period. Interest expense on the lease liability over the life of the lease using the effective interest rate method. That's one expense. Under a finance lease, a second expense is also recorded, equal to amortization expense, where we're allocating the cost of that right-of-use asset, leased asset that's recorded at lease commencement. We evenly allocate that cost over the lease term for the lessee. Here's an overview of the accounting for an operating lease. The lessee also measures interest expense. However, they don't report interest expense on the income statement. They measure interest expense, and that's going to affect the value of the lease liability. But the actual expense that is reported on the income statement is called lease expense. And lease expense is going to be the same each period. Now let's get into the details of accounting for operating leases. Remember, what makes a lease an operating lease is if it doesn't meet any of those 5 lease classification criteria that we talked about previously. When the lease is classified as operating, as I just mentioned, a right-of-use asset and a lease liability is recorded on the balance sheet on the start date of that lease, equal to the present value of those future cash flows related to the lease, just like it would be with a finance lease. But unlike a finance lease, the lessee records the same amount of lease expense each period over that lease term. Let's take a look at an example. Jazzway Disposal, the lessor, and Trailer Stores, the lessee, sign a lease agreement dated January 1st, 2020. The lease agreement specifies that Jazzway will grant right of use of one of its standard cardboard compactors. This is not of a specialized nature, at one of Trailer, the lessee's locations. Here's some information related to the lease. The lease is non-cancelable and the lease term is 3 years. The compactor, the leased equipment, has a cost and fair value at commencement date of the lease of $60,000 and an economic life of 5 years and a residual value at the end of the lease of $12,000. Now we don't need this information in this second bullet point would be needed if we needed to calculate what is the present value of this lease at lease commencement date, but we see here in this bottom bullet point that the fair value of the lease asset and lease liability, I've given you that, $49,925. The lease contains no renewal options. The compactor reverts to Jazzway at the termination of the lease. The implicit rate of Jazzway, the implicit rate in this lease contract is 6%, and the lessee, Trailer, knows that. The lease requires Trailer to make annual payments of $17,620 on January 1st of each year, beginning on January 1st, 2020. So our first question is this an operating lease? Chances are it is because our title here is called Accounting for Operating Leases. But let's go through each one of these criteria. One, is there a transfer of ownership in the lease term? No, we don't know anything about that. The asset reverts back to the lessor at the end of the lease. Is there a bargain purchase option? No, there's not. How about the lease term test? Is the lease for about 75% or more of the economic life of the asset? The lease term is 3 years out of the 5 total years of economic life, so it does not pass that test. How about the present value of the lease at lease commencement date? How does that compare to the total, to the fair value of that asset? The present value is 83% of the fair value of the equipment, so it does not meet the 90% present value test. And lastly, the alternative use test. The equipment is not of a specialized nature, so there is alternative use. So therefore, the answer to every question is no. So this must be an operating lease. Now let's look at the accounting. Trailer makes the following entry on January 1st, 2020 to record this operating lease. Again, for an operating lease, at lease commencement date, the entry looks exactly the same as if it were a financing lease. We're going to debit to increase right of use asset at the fair value of payments in this lease, which we are told is $49,925. The other side of this entry is we are recording an increase to the lease liability for the same amount. In addition, the very first payment is due on January 1st, 2020, so that would be recorded exactly as you would expect. Cash payment is made, so cash decreases. The amount we're told is $17,620. And this cash payment, no time has passed, so there can't be any interest component. So what are we paying off? We're paying off some of that lease liability. So we're going to debit to reduce the lease liability for $17,620. Now, after this lease payment is made, we record the lease and then we make the payment. What is the balance in the lease liability? Remember that even in an operating lease, we're still measuring the interest expense. We're not reporting on the interest income statement. You're probably wondering what we're going to do with it, and we'll see that in the next slide. But we do need to measure the interest component. So remember, what determines the interest component? It's the balance in that lease liability. So after this cash payment is made on January 1st, the balance in the lease liability goes from 49,925, is reduced by 17,620. So the balance in the lease liability after these two entries are recorded is 32,205. Some notes before we do our entry. When the lease payments are made on January 1st, an adjusting entry is needed to record three items: lease expense. And remember from earlier, we said the lease expense is going to be the same amount every year. We're going to work through how to calculate each one of these three items in the following slide. Another thing we need to record with this adjusting entry is an increase to the lease liability related to interest. So remember on the last slide I said we're not recording interest expense. What are we going to do with that interest component that the lease liability is driving? We're going to record it as an increase to the lease liability. And the third item that we're recording every year as an adjusting entry is a reduction in the right of use asset. So let's take a look at each one of these three items in a little more detail. The lease expense. Lease expense is always calculated as the total amount of lease payments across the entire life of the lease. Total lease payments divided by the lease term. And of course, when lease payments are constant, as they are in this case, we're told the lease payments at January 1st of each year, $17,620. If we say $17,620 times 3 for the numerator divided by the lease term of 3, of course, we're going to get our total lease expense is equal to our periodic lease payment. That's not always the case. Remember, we had an example previously where we saw that lease payments increase by 4% each year. In that case, each lease payment would not be equal to the lease expense, of course. Lease expense over the life of the lease is equal to the total cash payments, of course. But the lease asset and the lease liability are initially recorded not at the total amount of cash payments. So remember we said the total cash payments are $17,620, and 3 of those payments need to be made. So what is the total amount of cash payment that's going to be needed that the company is going to make over the life of the lease? Total lease payments are going to be $52,860, but the present value of these lease payments, in other words, the lease asset and liability that was recorded at lease commencement date, was $49,925. What's the difference between the total payments and the present value of the total payments? Time value of money, discounting. And what does that represent? That represents interest. So to finish the second sentence here, but the lease asset and liability are initially recorded at the present value of the total lease payments. And it's this reason, this difference between recording the total of the expense over the life of the lease equal to the sum of all the cash payments, while the asset and liability are the present value of the total lease payments. So if we just recorded the decrease in the asset and the liability, we would have this mismatch between the expense, the total expense over the lease term, and by the amount by which we're reducing the asset and liability. So therefore, a time value of money component, that's also referred to as, of course, interest, is accounted for related to the lease liability. Here's what another component of the adjusting entry would look like. So remember, we said one component was the lease expense, as total lease payments divided by the lease term. A second component of our adjusting entry is the increase in the lease liability. And the amount of the increase in the lease liability is determined as the beginning balance in the lease liability in that period, multiplied by the interest rate on the lease. Remember, we're using from the lessee's perspective, we're using the interest rate that's implicit in the lease agreement if it's known. Otherwise, we use the lessee's incremental borrowing rate. The lessor always knows the interest rate that's implicit on that lease. And we get, whereas we recorded this previously in the finance lease, we recorded this as interest expense. Now we're recording it as an increase in the lease liability. See here, interest is being calculated as part of the entry, but the amount is not reported as interest expense. And then that third component, we said one component is lease expense. The second component is an increase in the lease liability. And the third component of our adjusting entry is we need to reduce that right of use asset. And how do we come up with that decrease in the right of use asset? We start with the lease expense. From that, we subtract interest on the lease liability, or that increase in the lease liability. And that difference is the amount of the decrease, or the reduction, to the right of use asset. So let's go now to our first adjusting entry. Remember, the two entries that have been recorded so far, the company recognized the lease liability and the right of use asset equal to the present value of all the lease payments, $49,925, and then same day also recorded the first lease payment. We have made a cash decrease and we reduced the lease liability. The lease liability, remember, has a balance of $32,205. And we need to know that because when we're making our adjusting entry, let's just write this following entry on the entry on December 31st. This is our adjusting entry for three components: lease expense, so debit to increase lease expense. And what is the amount of lease expense? Total lease payments divided by lease term. In this case, where we have constant lease payments, lease expense is equal to the lease payment, $17,620. Second component, we increase the lease liability. So to increase a liability, we're going to credit lease liability. And by how much are we going to increase this lease liability? It's going to be equal to the beginning balance in that lease liability, which we just said was $32,205, and multiply that by the interest rate on this lease, which is 6%. And that works out to be $1,938. The other component of this journal entry, reduce the right of use asset. So we're going to credit to reduce right of use lease asset. And by how much? By the difference between lease expense and the amount of the increase to our lease liability due to interest, or time value of money. So we're just plugging this number into the right of use asset so that we can make sure that our lease expense is the exact same every period. This works out to be a decrease in the right of use asset of $15,682. So what is the balance in the lease liability after this entry is recorded? Well, right before we recorded this entry, we said it was 32,205. And what did we do here? We increased. Remember that first cash payment decreased. Here we are increasing the lease liability by 1938. So the balance in the lease liability at this point is 34,243. The next journal entry is going to take place the very next day on January 1st when the company makes the cash payment. Here's just we're not recording the journal entry on this slide. We're going to do that on the next slide. We're just going to write the note that when the cash payment is made on January 1st, or each time a cash payment is made, the lease liability decreases by the full amount of the cash payment. And on this next slide, we're going to record that journal entry. So the second lease payment that takes place on January 1st, 2021 would be, we know what it would be. We're going to credit to decrease cash, 17,620, and then we said on the last slide, the full amount is a decrease to the lease liability. So after this entry is recorded, what's the balance in the lease liability account? We said 2 slides ago, we said it was 34,243. And then we booked this entry. And what did we do here with this entry? Did we increase or decrease the lease liability? So just kind of showing the importance of remembering when do we add, when do we subtract. We debited to decrease the liability, so we reduced it by 17,620. So after this journal entry is recorded, the balance in the lease liability is 16,623. The next thing that happens is time passes and it becomes December 31st, 2021, and the company needs to record an adjusting entry. This is the second adjusting entry for lease expense, December 31st. So of course, we're going to record an increase in lease expense, debit lease expense. The amount is going to be for our usual 17,620, the amount of the cash payment, since these cash payments are constant. We need to increase the lease liability for the time value of money or interest component. And how much is our increase to the lease liability? Well, we just said that the balance in the lease liability is 16,623. And the rate is 6%. So this works out to be 997. And what do we do with the difference? We plug the difference between 17,620, or one debit, and the one credit of 997. We plug that difference of 16,629 to decrease the right of use asset. What's the balance now after this entry is booked? What's our balance in lease liability? It was previously 16,623, and we increased for the time value of money by 997. This brings our balance in the lease liability to 17,620. That number should sound familiar. What happens the next day, January 1st, 2022? The third and final lease payment is made. Every time there's a lease payment, we reduce the lease liability by the full amount of the payment, and we record the decrease in cash. So what's the balance in our lease liability at this point? 0. We've made that last payment. So it's December 31st, 2022, the very last day of this lease term. And what does the company record? They have to record lease expense for that year. That is equal to the cash payment, just as it had been. And there's no interest expense, right? There's no increase of the liability because our beginning balance in the lease liability is 0. This is because the payment was made up front. And the other side of this entry is going to be a decrease to the right of use asset of 17,620. What about the accounting treatment from the lessor's perspective? We use the same classification tests that the lessee did. None of the finance lease criteria are met, so it's an operating lease. Under the operating lease method, the lessor continues to recognize the asset on its, so the lessor keeps the asset on the balance sheet. This differs from the finance lease where we sold that asset. Now they keep it on the balance sheet, and the lessor is going to record lease revenue each period. And generally straight line, so the same amount of lease revenue each period. And so since the lessor keeps that asset on the balance sheet, the other thing it needs to record is depreciation. So the lessor also depreciates the leased asset. In this example, the lessor is going to use the double declining balance method, but it's really generally whatever that lessor typically uses, whatever method they're typically using to depreciate their assets is what they would use under the lease as well. So let's return back to this same example. None of the terms have changed here. Let's look at the accounting treatment from the lessor's perspective. Josway records the lease payment on a straight line basis. So every year, January 1st, 2020, 2021, and 2022, the lessor receives cash of 17,620. Remember, from the lessee's perspective, they were making that cash payment. But now what's the other side of this entry? Well, because it's eventually going to be revenue, but because these payments are received by the lessor on January 1st, before that full lease term starts, the lessor is going to record this as unearned revenue. And over time, that revenue is going to be recorded. On December 31st of each year, the company is going to record as an adjusting entry the revenue that's earned. So Josway, the lessor, will decrease unearned revenue and then record lease revenue. Okay, so notice this is saying every one of these 3 years. In the last example, we did the entries individually for each of the 3 years. Now we're just saying the exact same entries will be booked at the end of every year. And then in addition, the company also has to record at the end of every year, they're going to have to record depreciation expense. Here we're just going to see one depreciation expense because it won't always be the same under the double declining balance method. The amount of depreciation expense, the cost basis of 60,000. And remember that double declining balance method, we say 2 divided by the estimated useful life. We say the estimated economic life was 5 years. So this is 40% of 60,000. The company is going to record depreciation expense of 24,000. And of course, the other side of that entry, accumulated depreciation. This is just a regular depreciation expense entry from the lessor's perspective. The point is that the lessor does not take this asset off the books. And then last point, Josway, the lessor, records any other costs related to the lease arrangement, insurance, maintenance, and taxes as an expense when it's incurred. And this concludes our final video of the semester.